Get started. Okay, so this is an online seminar for P6 for ACCA Belfast. I have Claire and Marty and Ola with us tonight. So what we're going to do is we're going to go through December 13 and each of the IHT and CGT aspects that came up in the December exam. Okay, we're going to run through the question first. And then each answer, and then subject to time, we're also going to run through what the examiner said in his post-exam guide in relation to students' performances in each of the areas, each of the CGT or IHT areas. Okay, so I'm just going to bring up the question first here. And just bear in mind my comments about the sort of chat box. I should be able to see it, but if I don't respond very, very quickly, then just bear with me. Okay, so this first question, we've got really two questions in December 13 that relate to IHT and CGT, and this is actually the second one. This is the easier of the two. Okay, this is the section B question 3, Pescara. Okay, so what I'm going to do is I'm going to run you through the requirements first, okay, and then the body of the question itself, and as I say, then we're going to move on to the answer. Okay, so what I'm hoping that we'll do from time to time is maybe just stop and just get a fix on whether or not you're sort of with me, or if you have any comments to make on what we've covered so far. Okay, so firstly, just down to the requirements. So this question had, in effect, 3 main parts, okay? And it was, I would say, a sort of a medium to high level difficulty question. I think question 1, as ever, was a little bit more complex. This one here, in terms of its sort of overall span, really related to reasonably straightforward IHT and CGT calculations, the basic calculations. But as ever, he brought in reliefs. Yeah, and what you recall from the classes is what we have to do within P6, we have to rote learn the reliefs, because if we walk into the exam without knowing the sort of the basic core elements of every relief, and that's from CGT to IHT, we're going to have a problem. But for me, in terms of the reliefs, rote learning them is the first thing. The second thing, and it's evidenced quite well in this question, is just getting a fix on really how they work and being able to work them under pressure, when you're on in the stress of the day. Okay, so this is a good example of a question that brings them in. It sort of signposts them a little bit, but there are certain areas of this question that I think are a little bit tricky. Okay, so the first area for us is this part A. Okay, we have some sort of calculation of IHT payable in relation to a gift of shares in a quoted company. Okay, and obviously they refer to the fact that she's died. Now, what we're going to see within the answer is that this brings in our two sort of main calculations really for IHT. The first one is just some sort of lifetime calculation, and the second one is a death estate. Now, they're fairly straightforward in relation to Marina, and if you look at the marks here, what you can see is there's a reasonable amount of marks out of some 20, nearly a third of them, really for a fairly straightforward inheritance tax calculation. I think the problem for students and perhaps students in December in this particular area of the question is the fact that there was a lot of information about other things. So it's really a question of being able to pull out what's relevant to, very simply, this gift, the IHT calculation in lifetime if it's relevant, and also the death calculation. And you'll find within the answer that they do it as a job lot, in other words, in one area of the answer. Okay, so I'll come back to that. That looks reasonably straightforward IHT. Okay, now in relation to the CGT area, the CGT liability for Pescara, yeah, what we have here is really multiple transactions. There's not just one, there's several. Okay, so what we need to be careful of is not only the nitty-gritty, i.e. the EIS and the deferral relief, etc., but we need to be clear on how you're going to lay things out, because you're going to have more than one three-liner or more than one gain to calculate. Okay, But in terms of the nuts and bolts, in order to be able to get 3 out of 6 in that, it was fairly straightforward to do, because to a large extent, it was a 3-liner. It was proceeds less cost equals gain, and then the deduction of an A, and then the application of a rate. Okay, so again, I'll come back to the detail of that when we run through the question and the answer. Now, this B part 2 here relates to this EIS, and EIS, VCT, and those sorts of tax mitigation areas do come up fairly regularly, and they have several twists and turns. And what he was really checking in this answer is whether or not you knew clearly what the twists and turns were. So it's not just a question, as we'll see from this answer, of knowing that EIS relief is available in respect of income tax, but also knowing the CGT deferral relief, and also being able to pontificate about its sort of use, time limits, losses and gains, etc., etc. So I think what we learn from this question is that, and I think he mentions it within the post-exam guide, is that students may know a little bit about EIS. In other words, they may know that you can get income tax relief, but as far as it goes from there, their knowledge is very, very weak. So it's really the nitty-gritty we've got to concentrate on in respect of those types of areas. Okay, this part C here for me was really sort of something that we've discussed in class. In fact, I think we discussed it last time round when we met. Just this idea of a sort of a gift with reservation. And he does make several points in relation to his post-exam guide about how the fact that some students sort of knew it was a gift with reservation, but didn't actually answer the question. So I'll explain exactly what we mean on that a little bit later when we go through the post-exam guide. But you've got to be very, very careful here as to answering the question that he has set. Okay, specifically what I'm talking about is that he's asked to explain how it will be treated in calculating the inheritance tax due. He hasn't simply said provide the gift with inheritance, a gift with reservation rules. And a large number of students simply banged through the rules, but they didn't give an explanation as to how the gift would be treated. Okay, so let's move up to the top end here, the top end of the question. Okay, I'm just going to check to see whether or not you're all right. Bear with me 1 second. Okay, everything seems to be okay. You're quiet so far. That's good. Okay, so what we have so far, what we know from the requirements is that we have a couple of computations to do, IHT and CGT. In addition, we have some sort of gift with reservation, and we probably have some reliefs thrown in. Okay, so if I was reading this question in the exam, I mean, the first thing obviously that you pick out, having now read the requirements, is that it looks like there are some calculations. So that's just a reinforcement of what we already know. Okay, and in addition to that, they mention the EIS relief and also the relief relating to EIS and how it works. Okay, so that doesn't tell us anything new. Okay, now in relation to the detail of the answer, Pescara and her parents. Okay, now where you have a situation like this, where you have details on deaths of several people, yeah, the chances are that there will be a gift from one of those people, if not both of them, to the main party involved, in other words, Pescara. Okay, so, and that indeed is what happens within this question, because there's a gift from Marina to Pescara. Now, he provides information here in relation to domicility. In other words, that they're both, everybody is in effect domiciled in the UK, and what we'll be familiar with within IHT is that probably makes any IHT calculation a little bit more straightforward, because there's no issue with the location of any assets, okay, on death. Okay, so we have a fairly straightforward calculation if we're required to do any sort of IHT death estate calculation. It should, broadly speaking, be a list subject to any lifetime information that we're given. So this first bit here, if I was reading it, I would just note the fact that both parents are dead, and maybe that there is some sort of link between the death of these two parents in the sense of perhaps a transfer of some nil rate band. Okay? So if we move on to this detail here, we're given more detail in relation to Galvez, her father. Yeah. Now you have to ask yourself, given the fact that we know that the question, broadly speaking, is about Pescara, you have to ask yourself, why is the examiner doing this? Yeah. And there was only one reason, and it was a fairly small amount of marks, as mentioned above. It was simply just the transfer of the nil rate band. In other words, the transfer of the nil rate band from husband to wife or vice versa. And the key point for us here, and you'll see this evidenced in the answer, the key point for us here is that we know that he's died in 2007. Yeah, we know that here he is making on his will, he is making some bequests. So all that he did was to leave really two amounts, to Pescara and to her brother. So in other words, if you think back to 2007, he will have had a nil rate band. I think it's somewhere around about 250,000. And we're given all the information here in relation to his estate. And the reason that we're given that, as I said above, is in relation to a transfer of any unused nil rate band from him to his wife when she died. Okay, so back to the plot here. If we have a nil rate band, how does it get used up and how does it get transferred? Well, essentially, all we do at the date of death is to take any bequests that he made. So in other words, if we were to look at his will back in 2007, what it simply said is I leave £80,000 to each of my daughter and son, yeah, and the balance or the remainder to my wife. Yeah. So in effect, in terms of the usage of his nil rate band, all that he's using is 80 and 80. So let's just say, I can't remember the exact detail, but let's just say it was 250. Then what we're looking to do is to take two lots of 80 off 250 and then have the difference really uplifted to current year levels or to October 2013. So really the only reason why he was mentioned and this section here is mentioned, yeah, is simply for the transfer of the remaining nil rate band. And we'll see that in the answer. Okay. So moving on from here, we have some details in relation to the mother. Yeah. So we were told in the requirements that we're going to be asked to do something in relation to this gift. So here we have the detail of the gifts, and this section is part A, the pet and the estate calculation. So we know that where we have a gift to an individual, yeah, it's a PET. Yeah, it's a PET, and that means obviously that there is no tax in lifetime. But we have to think, when we read down an answer like this, we have to think about laying out that sort of basic computation in lifetime. And we know what that looks like. We'll see it in the answer. But essentially, that's the value of the gift, whatever it is, yeah, less any AEs that are available, less any nil rate band, okay? And then in effect, we get the net gift, okay? Now, what they do in the next section here is that they give us some details about the valuation of the shares, the valuation of the quoted shares. And we know that the quarter up rule is the rule that we would use to value quoted shares. So all that we're getting in these sections here is, number one, well, here's what she gave her in February 2009. She hadn't made any other lifetime gifts at all, and she doesn't have any other assets because there's no other information on them. So here's the detail about how you can value the shares. And again, as I say, we're talking about the quarter up rule, okay? And we know what that is, yeah, or we should be familiar with that. There's no curveballs in this area of the quarter up rule. Sometimes what they do is they'll give you quoted prices, they'll give you the highest and lowest marked bargains, but they'll also say something like, and there was a special bargain to be had at XYZ price. And we always ignore special bargains. So really, so far what we have in relation to the PET and the estate calculation part A is really we have some information in relation to the valuation of the shares that are being gifted from Marina to Pescara. Yeah, all of this stuff here is just really relating to the valuation, a little bit of background information on taper relief and also NRB or part NRB that may be available in relation to Galvez. Okay, so if we move down a bit, what you'll see here is there's specific information here in relation to the fact that the shares did not qualify for business property relief, i.e. for IHT, or for capital gains gift relief. Now that information is given for a specific reason, which will become clearer once we go down a little bit. But essentially what we're saying is that the value is the value. There's nothing messy in relation to the calculations, and in effect tax will be payable if it's due at the date of transaction, okay, because we're not going to be able to defer in any way by using BPR or even gift relief. Okay, so Part B here, I'll just remind you what Part B says. We're talking about CGT, yeah, and it brought in the EIS situation. So we're asked to calculate a CGT liability for 2013 or 2013-14, and also bring in the sort of the impact of the EIS deferral relief. So more of that a little bit later. So if we have a situation where, excuse me, if we have a situation where we have any sort of takeover, and that's effectively what's happening here, you'll note that Pescara has the shares. In other words, the shares have been transferred to her up here, yeah, so in 2009, and then it looks here as if there's been some sort of acquisition or indeed takeover of Sapang PLC by Zolder PLC. Yeah. Now, there's quite a lot of information here, and I think it would have been probably easy to get confused. But what we've got to be familiar with is just our ID rules for individuals and indeed for companies. Because if we see a set of purchases, or indeed a purchase, then a bonus, then a purchase, then a rights issue, if we see a disposal of shares where we're trying to come up with a cost, what we've got to appreciate is that we've got to use a pool of some kind. In other words, we have to set up a pool. I think I might have mentioned stamp collecting. Excuse me, I may have mentioned stamp collecting when we were in the classes. But essentially, if an individual has a batch of shares and that batch has been developed over time, in order to be able to establish the cost, we've got to build up a pool from the date of the first transaction, as it were, all the way up to the date of disposal. Okay? And all that's happening here is, over and above that, is that really we have a takeover sort of mixed into it. Now there is a question like this in the study kit, which is sort of similar, or the study text, in fact, which is sort of similar to this, because this is fairly straightforward if we can get our formats right. And the format essentially is, first things first is we need to pool the shares. Yeah, and the next thing we need to do is we need to establish, if there is a takeover, what is she receiving for her shares in Zapang PLC? In other words, what's she getting? Because you'll remember the rule within tax is, if you are receiving cash in some way, and let's say shares on top, then what the revenue want to do is they want to tax you on the cash. Okay. Now, that's you have to take that as road. That cash element, or that takeover or that cash at takeover, is not overly relevant for us, because the date of this transaction, in other words, the date on which Zolder PLC took over the company, was in 2011. Whereas we're required to do a CGT comp for 2013-2014. But we still need to know the split in order to be able to make up the pool. Okay? So over and above that, we see that there's a bonus issue. So we know we're going to have some sort of set of shares that are incoming, and those shares are really incoming from her mother, Marina, at a particular value. And then over and above that, we have a simple bonus issue of 2 for 1. Now, remember with a bonus issue that it's simply at no cost. So if we have a pool, we're simply saying, well, we're adding in more numbers of shares, but no additional costs. Okay. Now, in terms of the detail of the disposals, or the disposals of the capital transactions which would relate to Part B, what she is doing, and the reason that a gain crystallizes in 13-14, is that she's selling 1 million shares as at this date, November 2013, for this value. Okay, so indeed, for our three-liner, we've got our proceeds there, but we don't have the cost. The cost has got to come from the share pool. Okay, and in addition to that, a little curveball here, although they've mentioned the EIS shares, is that they, on the 1st of April, so right at the end of the tax year, they show us that there has been an investment of 50k into EIS. Now, as I said earlier on, it's important to know the CGT and IT aspects of investments such as EIS and indeed VCT. And as I said, within the PEG, what he sort of moaned on about was the fact that it was clear that students didn't know the CGT aspects. They had a fix on the IT aspects. So I think what some of them did is take a tax rate and multiply it by this value. And we'll note from the answer that if we're purchasing shares and we're using EIS deferral relief, then in effect we can shelter £50,000 against whatever gain occurs. So it's the full value of the shares that's used as the offset, not some percentage of it. Okay, so next part here is just relating to part C. This was the gift with reservation, and you'll see that he's kind enough to actually tell you that it's a gift with reservation. So really maybe he was hinting a little bit, he wants a little bit more information. And you'll remember from the requirements, if I move down, it specifically said explain how the proposed gift will be treated for the purposes of calculating the inheritance tax. So it wasn't just a question of regurgitating the basic stuff on gift with reservation. Okay. We know, broadly speaking, that there's a couple of options that the revenue would take the highest, but he wanted just a little bit more than that. Okay, so I'm just going to check back to the chat box here just to make sure that you're all right. Give me a thumbs up on your mood if everything's okay, if you're with me so far. If you could give me a thumbs up if you can. Just click on my mood, or if you're not okay, just give me a thumbs down. Marty's okay. Good. Claire, how are you doing? Good, good. Okay, I'm just wondering if you could let me know which out of us tonight, who attempted this particular question? I just wonder if you could maybe chat through. If you could chat through and let me know maybe a yes or a no, or let me know if you did or didn't. I'm just resetting your moods here. Can't remember. Can't remember. Okay, Maury can't remember. Claire can't remember. Okay, Orla? Okay, no problem. No problem. That's all right. That's all right. I mean, we're going to go through it either way. Okay, no problem. Good. Just bear in mind, you can stop me if you need to. I'm going to go back to the PDF and just share with you now. So I'll just give you a summary of where we are with this first off before we launch into the answer. Okay, so first things first, when we look at these requirements, for me, you may not feel this, but for me, there's some easy marks to be had for not doing too much at all. And invariably, I always think that when I see calculate inheritance tax or calculate CGT or calculate income tax due. And the reason that I say that is not that there aren't areas of this that are very, very tricky, because I think there are. But I think one of the things that we need to okay, Marty's not well, no worries. One of the things that I think we need to be careful with or aware of in relation to Rory Fish and indeed the P6 exam is that there are easy marks to be had. And the danger sometimes, I think, is when you get a question that has some tricky bits in it, to focus in on it. I mean, with an IHT calculation, you'll see this when we come through the answer, and indeed with this one, I'm going to point out to you where the easy marks were. And there were several of them, okay? And I'll also point out to you where the difficult marks were. But I think when you get any sort of calculation, just do try and be aware of the fact that you're going to get marks for doing sometimes very little. So, for example, putting in a proceeds or putting in an AE or calculating tax based on a taxable value. So don't forget the easy marks. I think that's the key point. So before we look at the answer, in terms of the detail here, as we've said, we've got a sort of a lifetime IHT calculation and then some sort of death estate calculation, albeit a fairly straightforward one. So I think we should have a chance of scoring reasonably well on that, subject to the valuation of the gift. In other words, that quarter up rule, okay? So I'll come on to the detail of that in a moment. This second part here, we've got a little bit of work to do to be able to calculate what the CGT liability is, and that involves the pool and indeed dealing with all possible transactions, okay? This part B here, really, if we didn't have specific knowledge of the EIS deferral relief, obviously we would have struggled with this, and he's very, very specific about what he wants. He mentions that within the post-exam guide. This third point here, as I've mentioned, I think the tricky bits are that he wants a real detailed answer on this, a real detailed explanation. Okay, so if I move to the answer now, okay, and let's start with part A. So you recall what we were asked to do was to calculate the IHT payable in relation to the gift of the shares. Now we know that Marina had died, yeah. So we have a situation where she makes a lifetime gift to her daughter, yeah. So first things first, what you'll see here, and this is our fairly sort of standard calculation, albeit for the fact that they've lumped in the lifetime bit with the death bit because it was so straightforward. Okay, so the lifetime bit is really the first bit, the bit at the top here, the first 4 lines. Now, what you'll see overall with this calculation, and I will move the screen down in a second, is it's a fairly clear layout. It's sort of easy to follow, and this would be the way that we would attempt questions in class. You know, at the end of the day, we're looking for some sort of value of the gift, yeah, 697. I'll come to the calculation of that in a moment. And then these bits here, here's some easy marks for us, because the question specifically said that there were no other lifetime gifts for Marina. So what we should have been able to pick up from that, then there must be 2 lots of 3 as the AE. We knew that no other reliefs were relevant. Therefore, you know, the value of the pet was simply the calculation based on the quarter-up rule, less 2 lots of 3 equals 691. Okay. Now I'll go quickly to the valuation, and then I'll come back to the further detail there. So what you'll see here is, again, we're just using the quarter-up rule. We know that that's just the lower price, the quarter of the difference between the lowest and the highest price, versus highest and lowest marked bargains divided by 2, and we simply take the lower one. Okay, so that would have given us 1.86 to simply multiply by the number of shares here at 375. So that gives us our value. Okay, then just deduct the 2 lots of 3, and we've got our pet. We know that a pet isn't chargeable in lifetime, and the reason that they've just tagged this area on is because it was a simple calculation. They thought they could do everything really in one place, and they're right. So what's the detail here? Essentially, from here onwards, we're sort of really talking about a pet becoming chargeable and a sort of a death estate. Yeah. So first things first, we needed to take off Marina's nil rate band. It's completely available because she doesn't have any other assets. Okay. Now the tricky bit maybe is just here, is the nil rate band transferred from her husband. Now you remember what I said earlier on is that where we have husband and wife and we have some unused nil rate band on the first death, then whatever is unused, we can bring that up at the current year level. Okay, so whatever he hasn't used. And you remember that what he hadn't used was 2 lots of 80. So if I move down to note 2 here, you'll simply see that, in fact, it was 300 in 2007, 2008. This would have been available per the tables. And he gave 2 legacies, or in his will, he simply said, I give this to Pescara and I give this to her brother. So the only thing that he did within his will, over and above leaving the remainder to his wife, is give out 160,000. So if he's using up 160,000, that must mean that the balance at that date was unused, because obviously he didn't need 140 to cover his interspouse transfer, because we know that interspouse transfers are completely exempt. You know, they have no impact upon the utilization of the nil rate band. Okay, so in order to be able to see what additional amount Marina could have that was relevant to Galvez, what we have to do is to see how much didn't he use, which is 140, take that over as a proportion over 300, and then multiply it at current year levels at the 325 level. In effect, a current uplift. Okay, well, and that's where we get the 151,667. So if we go back up to the question, what you'll see is we had the pet. That was the only thing effectively that she owned, and she gave it away, but it became chargeable because she died within 4 to 5 years. So we could take off her nil rate band. We could also take off his, yeah, because it's unused. And then we simply then have a balance that's going to be taxed at 40%. Now, the taper relief, we may or may not have been able to remember that, but essentially, where we have a pet becoming chargeable, there's bound to be some taper relief in play, unless it's 0 to 3 years, which would be taper relief at 0. Okay, that's really why he's put it in 4 to 5, because we know from 3 to 4 onwards, that's where we're getting some sort of value from taper relief. Okay. So really all that we had to do was to say, okay, well, that's the full tax of 85, but we can taper it down because of the fact that the death has occurred within 4 to 5 years of the gift. Okay, and that's where we get this figure of 51,560. Okay, so I'll just check that you followed that all right. Let me know, Claire and Orla and Marty, if you're back now. Let me know that that makes sense. Okay, just type in a yes perhaps, and let me know that you're with me so far. Claire and Orla. Okay, good. I'm hoping Marty's okay. I don't think he's feeling too good. Okay, Orla, does that make sense okay? I wonder if Orla is okay. Orla, let me know if that makes sense okay, if you want me to run through any of those points again. Okay, cool. Thanks, Orla. Okay, back to the plot. Oh, hold on. But the legacy bit. Okay, the legacy bit, would that not have been exempt? Yes, it would have been exempt, Claire. I'll go back to it. It would have been exempt. In other words, the you're talking about the 2 lots of 80. Yeah, in other words, the 2 lots of 80,000. So in effect, if we go down to the calculation, what's exempt? So bear in mind, we're talking about his death estate, so Galvez's death estate. So we're back now, Claire and Orla, in 2007, 2008. Let me just bear with me one, Claire. Hold on a second. Oh, you didn't realize that? Okay, no worries. Well, let me go through it just one more time. In effect, what we've got is a situation where we're at Galvez's death estate. So we're at the time that he died, yeah, which was in, what, 2007, 2008. So forget about everybody else's estate. Let's just concentrate on his. What he said in his will is, I give 2 lots of 80,000 pounds to my daughter and son. That's it. So if we were advising him at the time, and he asked us about his tax situation, his IHT situation, really on his death estate, this is in effect his death estate, all that he's using up in his death estate is 2 lots of 80. So in effect, he's got 140 left over. So he hasn't used it. He didn't have any other assets, so he didn't use the 140 at all. So really what the legislation prescribes in relation to the transfer to a spouse, a living spouse, is that if you haven't used it, you can certainly transfer it and uplift it at current levels. Yeah. So for example, a different scenario might have been that let's say that his estate was 500,000, yeah, and that he'd left it equally to his son and daughter. Well, that means that all of his nil rate ban was used up, because it was used up against the 500,000, and he had a tax bill based on 40% of 300,000. Yeah, do you see what I mean? So Claire, let me know that that makes sense, okay, or more sense now. Okay, cool, good. Right, so let's go back. So really what we have so far then is a situation where in this part A, fairly straightforward layout of a PET, yeah? We've got Marina's nil rate band at death. We've then got some nil rate band uplifted to current levels from Galvez because it's unused. And then there we have our calculation of 51. And then we're basically done, okay? So you can see here, there's some tricky marks, yeah? So in other words, let's just say the Galvez issue and the transfer of the nil rate band. Let's say that we missed that, but we're going to get marks here, here, and here, and here. So even if we'd ignored this Galvez issue and just literally used the quarter up rule, taken the couple of 3s off, or even 1, we probably would have passed this question. I mean, the marks on this, I think, were 7. So I would have said, in broadly speaking, in terms of marks, there's probably 2 for that, yeah, or 1.5 to 2 for the nil rate band. There's probably 1 to 1.5 for that, 1/2 and 1/2. Taper relief probably 1 to 1.5, and then for the calculation 1 to 1.5. So if we had simply used the quarter up rule and had a stab at getting that right, got to say these two, yeah, you put in Marina's nil rate band and maybe just multiplied by 40%, we probably would have passed. We probably would have got 3.5. So I know that, as I said earlier on, exactly this type of question won't come up, but certainly lifetime gifts are popular, as are death estates. We've got to focus in on where are the easy marks, and if we're not sure on something, just take a punt and move on. Okay. I spoke to a student in Dublin in relation to P6 IRE, so the Irish syllabus, and he said he spent probably an hour and 40 minutes on question 1. And by the time that he came to do the other questions, he had, broadly speaking, about an hour left, and everything went pear-shaped from there. So timing is key, and really not hanging about. We've got to make decisions. We've got to find some easy, some decent marks as quickly as we can. Okay, and there were some easy marks here, but some difficult ones. We just take a stab at the difficult ones. We don't have to get them all right. We didn't need 7 out of 7 in this one. Okay, let's move on to the second bit here, part B. Okay, now I'll remind you of the requirements. Basically, what we're asked to do is to calculate CGT liability for all transactions and bring in the impact of the EIS. Yeah, bring in the impact of EIS. Now, as I said earlier on, a CGT liability or CGT computation has some bits in it that we're fairly familiar with, okay? But it may well be that in the heat of the day it becomes very tricky, particularly when you've got tricky bits. For example, this cost area, in other words, the cost of the shares was tricky, okay? But before we go into the tricky bits, there were some fairly easy bits. I mean, this is the computation, yeah, and I'll go through the detail of this in a moment. But what you'll see here is there's our proceeds. We've always talked about our 3-liner, yeah. So there's our proceeds, and that was given in the question, yeah. So we'd get a mark just for putting that in our 3-liner. Here you'll see the AE being deducted, and here you'll see a calculation based on 28% because obviously she's a higher rate taxpayer. So the 18% wouldn't be available. And then over and above that, here's the deferral relief. So there were probably a few easy marks to be had for not doing a tremendous amount at all. So let's just say, I mean, hypothetically, I'm not suggesting that you do this, but let's just say that you were looking at this question, you saw, well, it's a CGT liability, it's got EIS, and there's some trickiness in relation to cost. Yeah, we can also see that the marks there are 6 marks. Now, most of the work is in here. In other words, is in getting this cost figure, and I'll explain exactly how they've done that in a moment. Okay, but let's just say hypothetically, gang, that you ignored that and just put in a figure, any figure. You just pluck 200 grand out of the sky. Yeah, if you had done that, and again, I'm not suggesting that you do, but if you had done that, that would have saved you a lot of time, obviously. You would have lost quite a few marks, but you would have got marks for proceeds, for the AE, for the multiplication by the rate, and if you'd done it for the EIS. I would say out of 6, there are probably 2.5 to 3 marks just for that cost working. But the balance of the marks are for the other numbers. So we're talking about, I would say certainly 3 marks for the rest of the question. Yeah. So you can see how I'm thinking here. Again, I'm not suggesting you just fly around the paper not answering stuff, but I'm saying I'm just thinking in terms of tactics. When we do questions, we've got to be thinking, where's the easy marks? The difficult ones, let's just take a punt and get the flock out of there. Okay? So let's look at the detail of this. The first things first, she is selling 1 million shares. They give the proceeds in the question, and we know that those shares have come to her as a gift in part, in effect. In other words, that she's received the shares as a gift. So what we need to do is we need to look at the share pool and what has happened. Okay? So what you'll find here is, and I'm hoping that you can see this okay, here's working number 1, and this all relates to the cost of the shares. Now I'll just remind you that really, in relation to these shares, these are the shares that were in Sapang PLC. Yeah. Now, the market value of the gift came from Part A. That's that 697,500. Just remind you where that figure came from. Up here. That market value is 697,500. In other words, that was the date of the at the date of the transaction. In other words, at the date of the gift, that was the market value. So in effect, that's the value that she inherits herself as a cost. Yeah. So if we move down to here, all you can see or what they've done is they've simply said, well, okay, she's making a disposal of shares. Yeah. She originally had shares in Sapang, but she now in effect has shares in Zolder plc. So what we have to do is we have to go back and create a share pool and really build it up from the date the original shares were acquired all the way through to the disposal here. Yeah. And again, I'll refer you to my sort of stamp joke about, if you were a stamp collector, what sort of information would you keep in relation to your various stamp purchases over the last 30 years? Well, really, I would say I'm going to keep details of purchases, the value, the cost value, the date. So broadly speaking, a pool works like that. In other words, we simply had to record the details of what is happening from transaction to transaction. Now, the only thing that made this a little bit tricky was the fact that in between times, we had this sort of change from Sapang to Zolder plc. In other words, there was a takeover, and that sort of messed with our pool a little bit, but I'll take you through that in a moment. But over and above that, this is very much an ordinary share pool, which is an average cost pool, as we know. And what we're looking to do is, once we get to the end of it, we're trying to extract from it the cost related to any that we're disposing. Now, we know up here that in terms of what we're disposing of a million shares, because it tells us that in the question. So it's highly likely that Marty's alive. Good to hear, Marty. So it's highly likely if we get a share pool in a question, any sort of share pool, whether or not it's for an individual in this case or for a company, and remember there's slightly different ID or matching rules for both of those, there's highly likely that if we have to build a share pool, he's going to ask you to extract from the share pool only part of the cost, not all of it. And you'll see that he does that in this case. And we'll run through this in a minute, but you'll see that he disposed of 1 million, but there are actually 2,250,000 in the pool. Okay, so here you can see we're taking out of this pool 1 million shares and then an average cost for 1 million shares. Okay, so I'll come back to that in a second. So first things first, we know that the starting point for this pool had to be the market value at the date of gift. In other words, the value that she received them as. Yeah, there was no issue with reliefs or anything like that. So they simply start in the pool as 375,000 shares at the market value that we calculated, and you remember that that was just using the quarter up rule. Okay. Now here's the tricky bit. I think this is maybe the trickiest bit in the question. Okay. What we had, and I'll take you back to the question in a second, is that we have a takeover where consideration is being offered by Zolder plc to her for Zapang plc shares. And you'll ask, well, what are they offering? Well, basically what they're offering is two different types of things. They're offering some cash, yeah, and some shares, yeah. So in effect, if we go to the question, in effect what we're saying is this is going to be some sort of disposal because she is receiving cash. I'll just let you read this section here to see what's actually happened. Here's the cash and here's the shares. I'll give you a moment to read that. Okay, so all that we're told is that she's going to receive some cash and she's going to receive shares with a market value of £1 each. Yeah. So really, what we know from the legislation as mentioned is that that element of cash is going to be chargeable. But as I've said, sorry, Marty, bear with me 1 second. I'll just check you out. Sorry if I missed something. I had to run out again. No worries, Marty. I hope you're all right. Stick with it. Okay, so really, this acquisition took place in 2011. In other words, she received the cash and the shares in 2011. That's not our tax year, though. That's well before our tax year. So I'm not really interested in how much CGT that this 30 pence cash crystallized. What I'm interested in is what's left in the share pool. Okay, so if we go back to the share pool itself, what you'll see is, excuse me, what you'll see is that we've got, in effect, new shares coming in with a value. Yeah, she's getting some additional value, as it were. Yeah, and what we're required to do is really to bring in the shares and bring in or sort of adjust for this this 30p worth of cash, as it were. Yeah, and you'll see what they've done is they've simply used the part disposal formula. Yeah, by saying that if each share is worth £1, yeah, and we have two of them, that means the A over A plus B must be 2 over 2 plus 30p. So in effect, what they're saying is that at the time there is some sort of reduction in the value, excuse me, in the value of the cost here because of the fact there's a mini part disposal. Yeah, so there's a mini part disposal of what she had up here because she's receiving this element of cash. Yeah, there's a mini part disposal. Okay, so in terms of the number being brought in, really, she is getting 2 new shares in Zolder PLC for every 1 that she has in Sapang. So what we've really got to do is we've got to transfer these amounts here, i.e. the number that she had in Sapang and also the cost value, to the new level. Yeah, and the new level in terms of a number is really that the number of shares that she has, because these are now gone, she's had to give these to Zolder. The number of shares that she has doubles because she got 2 for 1. So there's the number sorted out. And in relation to this 606 here, really in effect what we're saying is that the disposal, the cash disposal or the disposal relevant to 0.3 brings this down. So it's as if in effect that they're saying that a disposal took place because she received 30p for each share in Zapang. So the new cost must be less. In other words, some of the cost was used up. If you take the difference between this figure and this figure, and it's roughly speaking about 91,000, what you'll see is that 91,000 really relates to the cash value that she received back in 2011. Yeah. So in effect, they're saying there would have been some sort of CGT payable in 2011 because she got cash into her pocket, and the cost that was used, the cost that was taken out of this pool, it might have been helpful if they'd actually had a deduction here of 91,000 so that you could see that changing from 697 to 606. But essentially the reason that it's different is because there was a disposal. She got cash. The revenue said, right, there's a disposal at this takeover because you've got cash in your pocket. Okay. So next thing here is this bonus issue. Now what we know from bonus issues really is that there's no cost attached in the pool at all. And the bonus issue, as I recall, was 2 for 1. So what that means is that she's going to get from Zolder 2 shares for every 1 that she holds. Yeah. So she held 750. Yeah. That means that she's getting literally another 1,500 or 1.5 million shares because it was a 2 for 1. Now you'll notice how that makes the figures bump up quite substantially up to 2250. So in other words, she started with 375 Zapang PLC shares. Yeah, those were handed over to Zolder in a takeover. What did she get for them? Well, I'll tell you what she got. She got 2 lots of Zolder PLC shares. So she got 750,000 shares in Zolder. Yeah. In addition to that, Zolder then did a bonus issue. Yeah, where she got 2 for 1, which means that the total number of shares that she had really at the disposal date or after all the transactions are reflected is 2250. Okay, and the relevant cost is 606. And as I've said above, the reason that that is reduced is because of this part disposal element here. Yeah. So if this is the share pool up to date, yeah, because that's all the transactions reflected now. If that is up to date, really all that we do when we come to a disposal is we say, okay, well, if a disposal is taking place, how many shares are being sold? Now we're told, as I pointed out to you earlier on, we're told how many shares are sold in Zolder. It's 1 million. Yeah. So if 1 million shares are being sold, what we've got to do within this pool is extract an average cost for that 1 million shares. And how we would do that very simply is, divide or just multiply by 1 million over 2.250 times the cost. That's how we're going to get a cost for those shares. We just extract the shares at an average cost value. And then we get the balance left over. In other words, this is the balance carried forward on the pool. So just let me check to see that you're okay. Okay, everybody okay? Just give me a thumbs up if you can, if you're okay with that. Claire and Marty. Yeah? Good. Okay, thank you. Okay, so back to the plot. So if we just bump up to the transaction, in other words, basically our three-liner, yeah? We're asked to provide CGT liability, proceeds given in the question. The cost is the tricky bit. So our cost that's just been extracted from the share pool is right there. Yeah, you'll see that figure is the element for the 1 million shares. But at the end of the day, as I've said here, we've got to get a cost figure. So even if you hadn't, let's say, just plucked a figure out of the sky of 200,000, let's just say that you knew that it was a pool, yeah, but you got a little bit stuck in it. Bottom line is you've got to get a number out of that pool quick, because if we don't get a cost, we can't get these marks. Yeah, and this is, I think, what some students perhaps will have done is that they would have got confused, maybe got stuck in the in the share pool. Bottom line is, if we don't have that cost, this does not work. I need a figure there, because that figure there is the key to all of these other figures. If that's wrong, maybe I'm losing 2.5 marks. If I made a stab at the pool, I might get a mark. Yeah. So it's really sort of your attitude towards getting an answer out. And obviously, I appreciate the technical difficulty in terms of the detail of this question. It's not just as simple as setting up a three-liner and off you go. But I'm just trying to give you a sort of a hint on mindset here. Okay. So in terms of this particular part of the question, essentially that was it. Yeah, we had a transaction that involved a three-liner. The messy bit was the share pool. So do look at share pools for companies also and for individuals, and bear in mind slightly different rules. We've got a sort of a 9-day or previous 9-day rule instead of a following 30-day rule for individuals. But broadly speaking, they work in a not dissimilar way. Okay. So next part of the question, I'm going to get you out for a break in a second. Next part of the question, B2, just related to the capital gains tax implications of Pescara selling the EIS shares. Now you'll notice in this section of the answer, we used EIS relief. So let's be clear on what exactly we did. What has happened, and we were given the detail in the question. Let me just find where it is. We're given some detail about her, as you can see, making a purchase in April 14 of EIS shares at 50k. Yeah. Now, if we know a little bit about EIS, we'll know that there are both IT and CGT implications potentially. Okay. And in addition to that, on the CGT side, we know that there's a deferral relief. Yeah. And that's what they've used in this section. In other words, that's why the gain was simply reduced by that £50,000. Okay. Because in essence, what the legislation says is that if you have a gain, any gain, it doesn't matter what gain it is, doesn't matter what asset it is, you can shelter that gain simply by buying some EIS shares. It's as simple as that. So that relief, EIS deferral relief, it really doesn't have any conditions other than the fact that they need to be PUCA EIS shares. That's it, really. End of story. Okay. So I think students probably would have missed that because they, as I say, they focused in on the IT issue relating to EIS, but the deferral relief for CGT purposes is as important. Okay, so if we go back to the question, really what we're required to do here is over and above what we did in B1, which was just simply deduct the 50k from any gain, is to state the implications of selling the shares at some point down the line. Okay, so what we needed to remember there is really a time limit, a time limit, and also use of losses and gains. I'll just let you have a quick look at this answer here. If you could have a look at part B, B1 indeed, if you could just have a read of that. Okay, so now there are several implications, and this is fairly detailed, and we need a few marks for it. But really, the first one to be clear on is we've deferred a gain up above. In B1, we deferred a gain. Yeah, it could be any gain on anything. We deferred it because we utilized the 50k's worth of EIS deferral relief. So really, as soon as those shares are, those EIS shares are sold, that deferred gain is going to crystallize. Yeah. In other words, it will simply just be payable, and the transaction date will be the date of the disposal of the EIS shares. So note that in relation to EIS deferral relief is that it's not like the gain that you're sheltering is never going to be chargeable to CGT. It is when you sell the EIS shares. So he definitely wanted you to say that first. Okay. Now, the other issue was really the EIS shares themselves. In other words, this first part relates to the Zolder PLC situation. In other words, the fact that we use the EIS shares to shelter a gain. This part relates to the EIS shares as well. And one key thing that we had to know was this number of years, 3 years, So in the first instance, what he says is that the treatment depends on when they're sold. So within 3 years, in other words, within the cutoff period, then the gain would simply be chargeable and any loss would be allowable. But if they can get outside the 3 years, ideally you're required to hold the shares for 3 years. Then any gain will be exempt and a loss will still be allowable. So you notice that the loss is always allowable in relation to the disposal of EIS shares, okay? And obviously, in addition to that, if we have a situation where we hold the shares for more than 3 years, then there's no clawback of the income tax relief, They haven't asked us for the income tax implications here, so we didn't need to say this. But let's just be aware of the fact that if you sell within that 3 years, then you're going to lose that IT relief that you will have claimed in year 1. Okay, so really for me, those are the key points in relation to this particular area. Just note the other point down here at the bottom in relation to utilization of a loss and income tax relief. Okay, so really for B1 and P2, for me, the easy marks, or there were several easy marks to be had. I think the difficult marks, I would say in total we had 6 and 3. So we had 9 marks in total with B. I would say of that, probably half of the marks at least were easy marks, and the bulk of them were up here, in this area of the computation. Okay, so let me just check that everybody's all right. Everybody okay so far? I'm going to give you a break. I have to reset your mood actually to be able to see your mood. Okay, I'm going to give you a break. It's now just coming up to 20 past. Yeah, thanks for that thumbs up. Now coming up to 20 past, I'll make it about 17 minutes past. Thanks for sticking with me so far. I'm going to just pause the recording. It's at just about 50 minutes now. I'll pause the YouTube recording and get it out to you as soon as it downloads. That could take about 3 or 4 hours for it to download. But I'll pause it now to keep it to a workable length. Bear with me 1 second. Okay, so our recording is started again, and we were just moving through onto part C in relation to Pescara. Okay, so part C, what they're asking us to do is to give an explanation in relation to the gift of the UK property. Now, they've given us a good prompt, and he does tend to do this. You know, he's not unreasonable. He does tend to do this. He's given us a prompt here when he talks about the gift of the UK property, that this gift is a gift with a reservation. Now, what we know by that is that the individual retains a benefit or retains an interest in the gift, and her interest really is that she's living in the property rent-free. Okay, so that's a good prompt, a sort of a signpost for us, but it doesn't give us the answer, obviously. Now, we know that, broadly speaking, with a gift with reservation, there are several options, and they're all up to HMRC. Yeah, and essentially they will choose the option that gives them the highest amount of tax. Okay, so in terms of laying out an answer, obviously it was going to be a written answer, that no calculations are required. But in terms of laying out an answer, we need to be very clear on what those options are. Okay, now this answer here, this part C answer, again, it sort of does a little bit of what I've discussed with you before. In other words, it does try and get the easy marks. Yeah, it does deal with the more tricky bits, but it does get the easy marks. Let me take you through it. Essentially, a gift with reservation of benefit is going to be a pet. It's going to be treated as a pet. In other words, it's treated as if it's a normal gift. Yeah, and the value that's used, as always, for a normal gift will be the market value at the time of gift. Now, broadly speaking, in the areas here, yeah, what we get is really another option. Well, really sort of two other options. Yeah, I'll deal with the easier one first. Okay, what they're saying is in part C2 here is if the reservation, in other words, if the reservation of the benefit is still in place when she dies, then the value of the property at the time of her death will be included in the death estate. Yeah. So more often than not, when I'm in classes, I explain sort of this bit and this bit, i.e. that in the one instance is simply treated as a pet, yeah, which will be chargeable if she dies within 7 years. But in the second instance, if the reservation of benefit still exists at the date of her death, then the property will just be included in the estate at the value that it has at the death date. Yeah. Now, if you think about it, with the property, it's highly likely that the value will have increased between the time of the gift, in other words, the market value at the time of the gift, which is what the pet is stated at, and the ordinary market value of the property if it's simply included in the death estate. Yeah. So more often than not, this value here is going to give the higher one. But let me also take you to this option here. And this option here really is that if the reservation of benefit is lifted prior to Pescara's death, there'll be a further pet equal to the value of the property at that time. Yeah, and then this would only be chargeable if Pescara dies within the subsequent 7 years. So I guess what we're talking about is 3. 1, 2, 3. Normally, what the examiner will do is he'll go for this one and this one, i.e. either it's a pet, treated as a pet, it may become chargeable, or it's simply included in the state at death, and that's highly likely to be the larger value. Now, what they say here is essentially that whichever option results in the higher tax, in other words, whether or not it's the original pet or 1 or 2, whichever results in the higher tax, the revenue will take the highest one. It's at their option. Okay, so you can see that there were some easy marks to be had if we'd known that it is a pet, it's treated like a normal pet, or even if we'd known that it could be simply included in the estate. There's some easy marks to be had. The advice is very, very clear, but just watch the detail that he gives. It's very, very detailed to get those however many marks it was 4 marks. Okay. So that really summarizes that first question that we're going to do. I'll draw your attention here. In fact, no, it's actually on the other question. I'll draw your attention to what I said at the outset, just in terms of layout and format. The professional marks are not actually here. They're in question 1, obviously. There's 4 marks there. But certainly, if you can lay answers out in a manner that is user-friendly for the marker, I think they'll probably tick more. And what you'll see from this answer, if we just scroll down one last time, what you'll see from this answer is that, you know, it's laid out in a very, very straightforward manner. This is just simply a PET calculation and a death estate calculation with a couple of tricky bits. Yeah, we've got some workings, obviously, quarter up. We've got the nil rate band transfer, but again, it's very, very straightforward. That might have been, say, your page 1. Okay. Then moving on to the B1, again, a fairly straightforward calculation in terms of a 3-liner with a very, very tricky bit here, but some marks to be had just for doing the simple things, okay? Again, with your workings down below, which was essentially the pool, okay? Moving on from that, really the written sections here, again, you know, just very, very short paragraphs. You know, he uses sort of, well, pseudo bullet points, and he uses points 1 and 2 down the bottom. So whatever you do, even if it's not perfect, it doesn't have to be perfect to get 50%. Try and make your answers clear to the marker. Okay. So I'm going to move on to the question number 1. I just want to check if everyone's okay for me to move on to question number 1. Just let me know if you're good to move on, or do you want to deal with some areas of that first question? Yeah? Orla, are you okay? Okay, good. Alrighty. What I'll do is I'll try and go through this one a little bit quicker, otherwise we may well be here for a very, very long time. So I'll try and speed up a little bit. Okay, so let me go to the question requirements for this first one. Bear with me 1 second. Okay, so this was question number 1. This is the first thing that you saw. It will have been compulsory, obviously, so you will have had to have done it. Okay, so the key points that we're going to focus on are really in B, 2, and 3, because that's where the CGT, IHT areas were. Notice the professional marks here for just the clarity or lucidity of your answers. And the key people here of concern were Farina and Lauda. Certainly, if you look at the split of the marks, much more work needed here for Lauda. This was the incorporation relief issue than for Farina. Farina was fairly straightforward, okay? And this area here, this sort of ethics bit, was probably fairly straightforward too, okay? And we had to get 17.5 to pass this, yeah. So if we could have scored a fair proportion of the professional marks and done reasonably well in this area and reasonably well here and perhaps here, then we could have afforded to fall down here in this incorporation relief area. But we had to make sure that we got the easy marks. I think there's probably 3 or 4 very easy marks to be had here in ethics, okay? We've got to know our ethics, because I think that's money for nothing. Okay, so let's look at the detail of it. We're asked for a memorandum, yeah, and it's important that we give them one. And we've done those in classes. It's pretty simple layout. Whatever you do, when they ask you to do something, do make sure that you do it. So do lay out a memorandum. We'll see what that looks like in a moment. Then we're asked for a couple of different areas. We're not going to deal with capital answers at the moment, just these 2. So I'll take you through the detail of what was required here. And when I take you up this answer, bear with me 1 second. Okay, so basically what we've got here is we've got a partnership, yeah, the FL partnership is going to be sold as a going concern to JH PLC. Now he's prompted again, you'll notice that he's prompted incorporation relief, because bear in mind it doesn't simply have to be a sole trader incorporating his business. We can get incorporation relief for any sort of transaction where really a business is being sold as a going concern and where there is a mixture of shares and cash. Okay, so in terms of the detail for Farina and Lauda, we're told that their additional rate taxpayers, that could be relevant in the future for us. They're using up their annual exempt amount, so we know that we're not going to be using those at all because they're not available. And also, thankfully, they're resident, ordinarily resident, and domiciled. So that makes things a little bit more straightforward, particularly from an IHT perspective. There's no messy business in relation to location of assets. Okay, so then we get some details on the sale of the business. Yeah. Now, in terms of the sale of the business, this is a confusing area, I think, for students, even leaving aside incorporation relief for the moment. But where we have the sale of the business, really what we need to know is what are the chargeable assets? In other words, what are the assets included within the business that attract capital gains tax? And this business only really had 3 assets, and only one of them was a chargeable asset. Yeah, 13 or 1.3 million with a nil starting cost. Obviously, when you set up a business, you've got no goodwill, so really your base cost is 0. Okay, but the value as at the transaction date of 1st March was 1.3 million. So we have an asset in a business that's being sold with a high value, no base cost. Okay, these two are not relevant for CGT purposes at all. Okay, they're not chargeable assets. Okay, so in terms of the calculation of the gain, or what they're being provided with, in other words, what they're receiving, what their consideration is, really what they're getting is really cash and shares in JH PLC. So really this is the disposal of a business for cash and shares. Okay. Moving down from that, in terms of future transactions, we've got basically each of the individuals disposing of their shares in some way, shape or form, their shares in JH PLC subsequently, both Farina and Lauda. Yeah, and what they're asking us to do in the requirements really is just make sense of the tax impact. Okay, so let's deal with Farina first. What she is doing in effect is making a gift of shares, yeah, in JH to a discretionary trust. Now we know that the treatment for gifts into trust is certainly different from the treatment to gifts to individuals, even if the beneficiaries are her nieces and nephews. But essentially that's a CLT, a chargeable lifetime transfer. So it looks like we're going to have to make some sort of calculation of what the value of the gift is, and then perhaps tax it in some way. And they've said, even here, they've said that Farina will pay the tax, pay the inheritance tax. So we know that that's going to be at 25%. Okay. So first things first, for Farina, we've got a CLT. So we've got to think of our formats. In other words, what's the format for laying out a lifetime calculation for inheritance tax purposes? And it's not dissimilar to the PET that we looked at earlier on, aside from the fact that obviously down at the bottom, we're going to have some tax calculation at 25%. Okay. Now, for Lauda, slightly different. We've got, she's going to give 40,000 shares to her son. And in addition to that, they've given us some details on valuations of shares. So we don't have to do any calculation, any quarter up issues or anything like that. Okay, so basically we've got disposals, and it looks like we've got to comment on the tax impact of those disposals. So in terms of the further detail, we'll leave the capital allowances. We're asked to give brief explanations, or indeed basic advice, any IHT payable by Farina in her lifetime in respect of the gifts of shares to the trustees, and the date on which that would be payable. Don't forget these little admin points and dates of payment. That can give us some extra easy marks. So essentially, that's exactly as I've said. We've got a CLT. What's the tax? We need an explanation of the tax payable. Okay. Over and above that, we've got an issue with regard to the availability of gift tax relief. Now, you remember I said in the last class, certainly the conditions are key for us, and how he plays with the conditions. And he certainly does play with this, with it in this question, because as I recall, it's not available based on the proportion of shareholding that she has. Okay, now, so they're asking for gift tax implications for her and indeed for the trustees when they transfer the shares on to the beneficiaries. So conditions are key. Now, in relation to Lauda, we've got a situation where she has the option, or she's considering whether or not to claim or disclaim incorporation relief. Now, in relation to incorporation relief, again, we need to know the conditions for these reliefs, but all that we're talking about there is a business, in this case, a partnership, being transferred into another company. And incorporation relief being available. They've told us that it's in play, in effect. Okay, so really, what does it do? Well, essentially, what it's going to do is when she receives the shares from JH PLC, the base cost of those shares has to be reduced by any incorporation relief that she's claiming. So in other words, what incorporation relief does is it says, oh, you're making a disposal of assets within a business or a business, and in effect, you're crystallizing a gain now. But if you claim incorporation relief, you can defer that gain until the date that you sell those shares. In other words, you sell those JH PLC shares. So really, if you imagine a situation where we have a base cost of £100,000 and we have incorporation relief claimed of £50,000 for argument's sake, the base cost going forward for the new shares is 100 less 50, i.e. 50. And that means that in 10 years' time, for argument's sake, if those shares are sold and we have to come up with a three-liner, then what we use as cost is the reduced base cost. And that, in effect, means that the deferred gain at the earlier date of the takeover, let's say, that crystallizes. And in addition to that, any further gains crystallize. So all the gains crystallize at a later date. Yeah, so that's essentially all that incorporation relief means. And in effect, what they're saying here is there is the opportunity to disclaim it. You don't have to claim incorporation relief. And really what we need to do is to work through the numbers to see whether or not it's advisable for her to claim or not to claim. Okay. Now, what they've said here down in this next paragraph, it's important to include a summary of calculations. So that's going to be sort of with incorporation relief and without incorporation relief, and making it clear as to any relief available and any additional or alternative reliefs, and also the dates on which CGT would be paid. So it looks like that section for 14 marks is a lot more complicated than the other sections, but I'm just about to take you through it now. Okay. So if we have a look at the detailed answer there for this, bear with me 1 second. I'll get up to the right part. Okay, so let's have a look at part number 1. That's here, isn't it? Yeah. So the first thing we had to do was, I had thought there was a calculation in here, but there's not. It was basically looking for an explanation. Yeah, an explanation. What they've said specifically is provide a memorandum for Farina, and then just up here they've got the detail. They said a brief explanation, the manner in which the IHT is payable and the date payable. Explanation of the reliefs to the trustees, or the transfer of the shares to the trustees, and from the trustees onwards to the beneficiaries. Okay, so basically an explanation. So what does that mean? Well, I can tell you what it means. It means dealing with the basic elements first. And again, I know I've said this 2 or 3 times tonight, is what a lot of students will have done within this question is start talking about the tricky bits, okay? But before you do that, you need to really state the obvious. And the obvious is that the gift, yeah, is a CLT, yeah? That means that IHT is payable at the time of the gift as we know. Okay, BPR in fact won't be available because it's a quoted company. She's not a controlling shareholder. Again, goes back to knowing the conditions for the relief. But even if we hadn't known that, if you look at the next sentence here, we know the transaction date, so we could very easily work out what the MV of the shares are at the date of gift. Yeah, and they've said very simply this will be reduced by annual exemptions for not only this year but also this year if they not been used against any other gifts. So leaving aside the BPR for the moment, what you can see in these first 2 paragraphs, and this is the 100% answer, is that they've said they've made fairly basic points. Yeah, and even going on in this next paragraph, again fairly straightforward. You know, we've got an excess over nil rate bands going to be taxed at 25%, have to be paid by Farina because that's what she's decided to do. Yeah, and in addition to that, the 325, the nil rate band, will be reduced by anything in the previous 7 years, and then just the IHT payable date of 30th of April following. Okay, so what you can see here for quite a few marks is not anything overly complicated. We will have done this in class quite a few times, so don't forget to state the obvious in these sorts of questions. Okay, so moving on from here, the gift relief issue. In fact, it will be available. It will be available because of this issue here. In other words, this idea that we have a relief called gift relief. It has a series of conditions. Probably the biggest mistake that students make is that when they see a gift, they think, well, it's definitely in play. Here's another one that they make, i.e. that what we don't tend to remember in relation to gift relief is that if IHT is in play, in other words, if IHT is payable on the transfer or on the gift, then gift relief will always be available. Yeah, it will always be available. So do make a note in your notes about this gift relief area, particularly when you have a transaction that attracts IHT as well as CGT. It basically that the fact that IHT is payable makes the gift relief claim okay. Yeah? Okay, let me just check that you're all right. Okay, everybody okay? Just give me a thumbs up if you are. Good. Okay, Orla, you okay? Yeah, good job. Okay, back to the plot. So we sort of dealt with the first part in Farina. Now, Orla, this is the more tricky bit, okay? But he does the same thing again, or the answer does the same thing again. What it says is the basic elements first, yeah? In other words, we've got the sale of a business, yeah? And in effect, the business just has one asset, and it's goodwill. And because they have a 50-50 split, that means that the gain for each of the partners is going to be 1.3 million minus cost at 0, split into 2. So very simply they say, well, her gain is potentially going to be 650,000. Now, I'll just scan you down this the answer here where they talk about incorporation relief or not using corporation relief. First part here, part 1, here's the detail, and I'll scan it in 1 second, with incorporation relief. So here's where she is making a claim, and they asked you for both. Okay, if we move slightly further down here, we've got part 2, i.e. without the incorporation relief claim. So let's deal with first things first. So if we have with the incorporation relief claim, now you remember what I said, incorporation relief is available for, let's say, a sole trader where they simply incorporate a business, but it's also available where simply a business is being bought out as a going concern, as in this case. Okay, so we know that the gain on the sale of the assets is 650,000. We could have had 2 or 3 other chargeable assets here. We would have just totaled the gains. Okay. Now, the incorporation relief calculation is here, and I'll take you down to note 1 in a moment. But just look how it works. We've got the gain on the sale of the assets, only one asset. We're deducting something for incorporation relief and really leaving a balance taxable. And it just happens that the balance is available to tax at 10% because entrepreneurs relief is available, but don't worry about that for the moment. And then very simply, they show the transaction or the payment date. Yeah, so a very simple setup. Looks like a 3-liner in effect to me. Okay, now if we move down to note 1, so excuse me, if you see here, and this is not dissimilar to what we saw earlier on. If I'll give you a chance to read note 1. Okay, so in essence, what this says to us is that yes, incorporation relief is available, but where an element of cash is being received, you know what we talk about cash, the revenue. See you getting cash in your pocket, and the cash in her pocket in this instance is 140,000. So in effect, what we're saying is that only some part or one part of the consideration is shares. So one part of it is, share for share, as it were. Yeah. And the value of that is basically the 200,000 shares times 3. And we were given that value, or those values in the question. Okay. So what we know is when we move up to the incorporation relief element is we know that we have a total consideration of 740, yeah, from JH, but of that, only 600 is in the form of shares. And within this area of incorporation relief, we need to be aware of the fact that where cash is being provided, then that element is in effect chargeable. Okay, so in effect, what we're doing is we're saying, well, this element we're going to strip out of the gain, yeah, leaving the balance, yeah. So that sort of the balance in effect relates to the cash, yeah, the cash that she's receiving. So incorporation relief must be whatever the gain is times the ratio between the shares versus total consideration of 740. Okay. Now you'll see here when we get the difference of 122, we're applying a 10% rate, i.e. the ER rate, and really that's because this qualifies as a business or disposal for ER purposes. In other words, she's basically disposing of a business that she's held for more than 1 year. So if we look at note number 2, I'll let you just read that area there for a moment. Okay, now it might have been easy to even just to miss ER relief completely. That's not a problem. I mean, if we'd multiplied by 28, it's not a problem. We're not going to lose a massive number of marks, but we did need to get a CGT payable figure. As I've said, the reason why ER relief is available is that a business is being sold, it's a going concern, it's been held for at least a year. That's it. Those are the only conditions for ER relief in relation to a sole tradership business or indeed a partnership. Okay, so if we move back up, so far what we have is an incorporation relief claim and tax at 12297. Okay, now in terms of the base cost of the shares, this is what I was talking about earlier on. What we do with incorporation relief is if we're using it as we have, so if we've sheltered this amount of the gain, yeah, we've basically taken that out of the tax equation completely. But where have we put it? Well, where we put it is down here, because we know that the market value of the shares that she's receiving is 200 times 3, yeah, because that's given in the question. So this is what she's receiving, so that's what she'll be holding on to and perhaps selling at a later date. But what incorporation relief requires us to do is to reduce the base cost by any incorporation relief we claim. So here's the base cost for future use of those shares. So if she comes to sell in due course, and certainly she's selling part of them or gifting part of them, then in effect, that's the cost that we will have to base all 200 on, all 200 of the shares, 200,000 of the shares. Okay, so that's the first section. The next thing that we do, and that really deals with everything up to really the claim for the incorporation relief, but there is another transaction, and it's the one here. And what you'll see is that we have a gift of shares in June 15. I'll take you on to note 3 at the moment. Now, you remember in the question they gave us a series of values, a series of market values at different dates, and the reason they did that, I just pointed out to you here, the reason they did that is to prompt us, yeah? In other words, to prompt us that these are going to be the proceeds of the MV depending on what happens and when, yeah? Okay, so in terms of the gift at 1 June 2015, really all that we had to do is to take the proceeds at that date. So that figure is in effect given in the question. We're just multiplying the number of shares being gifted by the MV at the date. Yeah, and then what we had to do is to say, okay, if a gift is taking place of 40,000 shares when we know that there are 200 held in total, then what we must do is we must go back up here to our reduced base cost, because remember this is the reduced base cost for all of the shares. Yeah, so we have to really take a proportion, yeah, 40,000 over 200 of that reduced base cost and put it in as our cost. Yeah, we had to do that. So we need to have a cost in a 3-liner, obviously. So we had the proceeds was given in the question at £5 per share. Yeah, the cost is just really a proportion of the reduced base cost, giving us the difference of 185. Yeah, and taxed at 28%. I'll just take you down to note 3 and 4 so you can read those as well. Just note 3 first. Okay, so note 3, what we're saying there is that no gift relief will be available because she doesn't qualify. Yeah, and in addition to that, there's no IHT payable on that gift as such. Yeah, so really what we're saying is that that's her percentage. It's under 5% of the company, and indeed the shares are quoted. So in effect, it's not her personal trading company. Yeah. So note number 4, just have a quick look at this. Okay, so we're told in the question that she's an additional rate, not just a higher rate, but an additional rate taxpayer. That means that 28% is going to be in play in relation to any gains that she has. And in addition to that, she doesn't qualify for entrepreneur's relief because she holds less than 5% of JH. Okay, I'll just let you quickly read the tutorial note there also in relation to ER and the employee requirement as well. Okay, so really, let's just recap on this. What we're required to do in relation to Lauda and point 3 is to really provide details of a comparison between incorporation relief being claimed and incorporation relief not being claimed. Okay, and there are a multitude of different reliefs that can and may be in play. And all that we've done is said, okay, incorporation relief, the business has been transferred as a going concern. What's the gains on the disposals of the chargeable assets? There was only one, yeah, and that was easy to calculate. Then over and above that, what is the consideration? In other words, what's she getting in shares and what's she getting in cash? Had it all been shares, all of the gain could have been sheltered. All of the gain, had it all have been shares, just under the share for share rules. Okay. In addition to that, we had an ER at 10%. Because of the fact that basically she was disposing of a business and she'd held it for more than 1 year. Then moving on from that, we had to reduce the base cost of the shares simply by deducting the incorporation relief. That means this is the base cost for future use. And then what he does, which he invariably does in this sort of situation, is has a disposal of part of this, in effect, part of this cost, 40,000 out of 200,000. Okay, so what we had to do is just take that pro rata, take that element out, and then just calculate at 28% as she's an additional rate payer. Okay, so that's the first part, which relates to the claim for incorporation relief. I guess without incorporation relief is probably a little bit simpler in some respects, because without incorporation relief, in effect, all of the gain on the disposal of chargeable assets, there's only one, crystallizes at the date of the transaction. In other words, at the date of incorporation. So we would then have simply a gain of 650, nothing deducted from it. The CGT rate would have been 10%, so just 10% of the gain, and very simply the 31st of January following as a payment date. Okay. Over and above that, in terms of the base cost of the shares, we wouldn't have had any adjustment to the base cost at all. We have market value of the shares received. We've got 600,000. That's per question, and then we've got a gift of those shares. Excuse me, a gift of those shares, or a gift of 40,000 of those shares at this date. And again, they give us the MV at that date, so we can simply just take that per the question. So notice that we're gifting shares. We have a value on this date, so the proceeds must be the MV at that date. Yeah. Now, in terms of the cost is as per the above. There was no change in that. Yeah. So all that we had to do is again just take it pro rata, 40 over 2,000, which gives us 120, and the difference being 80, and then simply multiply by 28%. Okay. And that was note 4 above. Again, for the same reasons, i.e. additional rate taxpayer. So really what we have then is a situation where we have two different transactions, one with, one without. We have two completely different tax values for each of the two possible scenarios. And what they do here is just summarize them for us. Okay. Now, we definitely need a comparison. You'll see that he's made it very clear within his answer, this is a summary. Now, within each summary, we're going to have two parts, because obviously we've got two separate transactions. You know, we've got the sale of the business, and then we've got the subsequent gift of the shares. So all we had to do was just to total the figures and really compare them to each other. Yeah, so we've got with or without. Okay, you can see that there's a marked sort of increment for without incorporation relief. So then we talk here about the sort of the key issues. I'm just going to let you read the detail here. If you could read this for me from here downwards. Okay, now some of this might lose a little bit in translation on a Wednesday night at 9 o'clock, but essentially what we're saying, and he's made it very, very clear here, is that there's a higher initial capital gains tax liability, as we'll see, yeah, without an incorporation tax claim. But in essence, what we're doing is if we don't claim incorporation relief, then what will happen is that the base cost of the shares will be higher for a future transaction. That's really essentially what this answer is about. It's about the difference between the base cost going forward and the initial tax with an incorporation relief claim versus no incorporation relief claim, i.e. this bit here. This is the bones of it and the reduction in the base cost going forward. Okay. So I'm going to sum up now, because I'm pretty sure you're tired, and I definitely am. Just going to come back to you and see if we can get some questions. Okay. Okay, I'm just trying to think now, in terms of what we've just been through on that one, has anyone got any queries on the question number 1? Anyone got any queries on that question number 1 at all? Any thoughts, anybody? Or does it seem, if it seems okay, let me know. Just need to go over it all. Okay, understood, Claire, yeah. Understood. Okay, Marty and Ola, any thoughts, any queries? I'm sure you've got loads of queries, but anything that you can type quickly?